I'm
Yes.
speaking as the moderator.
Yes, you get to start, Dan.
Yeah. Well, because we're running a little behind and because all these people are rightly well known, I won't try to give them their bios or something like that. But we're first going to have Reuven Avi-Yonah, who's the Irwin Cohen Professor of Law at University of Michigan Law School, and obviously a very leading scholar in international tax. Is going to talk about Ed's impact there. So that's going to be a longer piece of the panel because Reuven is basing it on a paper that he's actually already written. Then we're going to have a panel with three great people. Rosanne Altshuler, who's at Rutgers University, and of course, a really leading international tax economist and scholar, and has also had, in the same tradition as Ed, had government positions also, in which she's tried to, and think tank positions, which she's tried to advance thinking. Then Thornton Matheson, who's currently senior fellow at Urban-Brookings Tax Policy Center, has also been at IMF and at the OTA, and worked with Ed and has been an important person international. And finally, Vicki Perry, like Ed, a lawyer who's also worked with economists, who's the IMF Deputy Director at Fiscal Affairs Department, retired, and also a very eminent career as a tax lawyer. So with no further ado, Reuven.
Thanks, Dan. So I will share my screen, but first I want to say a few words. First of all, to thank Rosanne and the organizers of this really amazing conference. I mean, I can't believe you can have a conference in Ed's honor that's better than this. So this is really a wonderful opportunity. Secondly, I think I want to say a few words just personally about how I got to know Ed. So my first encounter was when I was in practice. I was working with Peter Canelos, who was the head of tax at Wachtell Lipton, and I was an associate. And as you've already heard from Les Samuels, Peter and Ed were best friends and had published together several articles. And so I got introduced to Ed through Peter, and Peter was a huge admirer of Ed and his contribution and his brains and everything. So I got a very favorable impression of Ed to begin with. Then in 2007, Kim Klausing and I did a paper for the Hamilton Project on formulary apportionment, and Ed was presenting in the same context his paper on the bite while he was still in practice. And two things impressed me then. One was how committed he was, as people said, to changing the world. He really believed in this proposal and was pushing it. And second of all, how sharp he was. He critiqued Kim and my paper to shreds, basically. So that was another encounter with Ed. Then, of course, when Ed went to academia and he wrote, in the same field that I'm writing in, then we started engaging more frequently, and it went back and forth on email for a very long time. And I have to say, I didn't always agree with Ed, and nor, of course, did he always agree with me. But one thing that I particularly objected to, I was clearly wrong, which was his use of the term stateless income in his articles. Because I said, how can you call it stateless income when it's tax havens are states? I mean, they're sovereign countries. It's not stateless income. But he was right. That was the great labeling, as was already mentioned in the beginning by Dan and Joe. And then eventually I really got to know Ed, because I was several times a visitor to USC, and he hosted me in his home in Pasadena with Rosanne, and he was already sick. And he was the most generous, imaginable host. He took me to the museum that Joe Bankman mentioned, and gave us, me and my wife, a tour. Rosanne and he hosted us to dinner. It was an amazing, amazing experience, and I learned to know Ed as a person, really for the first time, and I will never forget that. And it's a huge, huge, huge loss that he's gone. So let me go to the slides. And first, let me see. Okay. So basically, I won't go into this in too much detail because A, we are late, and B, many people know this already, and C, I don't like, reading out the slides. But fundamentally, before Ed came on the scene, US international tax policy was a mess, as Ed pointed out, because while in theory, we had a worldwide system, in practice, we had a territorial system, or an ersatz territorial system, as he called it, because the combination of deferral and cross-crediting meant that US multinationals were not really paying too much tax on their foreign income. Moreover, Ed, as an academic, came into the scene after Check the Box, and that completely eviscerated Subpart F, which was supposed to guide against that. So that was Check the Box, and after Check the Box, basically things began to unravel, and eventually we got to a situation where we had $3 trillion in offshore income, low tax by US multinationals. And then Ed came into the scene. He left the JCT in 2009. In 2011, he published Stateless Income and the Lessons of Stateless Income. And I think that these articles really had a major effect on US international tax discourse and policy, and that Ed really did change the world in this particular area. I don't think anybody can deny it. So basically, the main contribution in my mind of Ed's two articles was that traditionally the defense of check the box was that, or 954C6, which is the codification of it, is that it just allows foreign US multinationals to shift profits from high tax to low tax foreign jurisdictions. And what's bad about that? That was the multinational response to when the Treasury tries to shut them off in Notice 9811. And Ed showed that that simply was not true, that by allowing the shift, the foreign shift, you also permit shifting of US income to low tax foreign jurisdictions. So we really should care. And he used the famous Google double Irish Dutch sandwich in order to illustrate it. So I'm not going to go into that, but again, this was an amazing contribution. And essentially, he also pointed out that the complaints of the US multinationals about competitiveness, for example, given the de facto territorial system, the very low rates on foreign tax income, and the dubious justification that were put over, like capital ownership neutrality for for de facto territoriality, were all wrong. And he also pointed out the big flaw in the system, which was basically that the income was locked offshore and couldn't be brought home. And the big issue back then actually was, how could the big firms avoid taking a reserve on the future tax at 35% of the dividends? And it was getting harder and harder to persuade the accounting firms to bless this, because the income was supposed to be permanently reinvested offshore. But of course, everybody knew that they wanted to bring it back. So fundamentally, Ed proposed two, so this was the diagnosis, and then he made two proposals. One was, let's have a truly territorial system with a participation exemption for dividends from CFCs, but to retain Subpart F for passive income. And he said, the problem with that is that it will encourage even more profit shifting, because we really won't be taxing foreign source income. And the only solution to that was something like a true formulary apportionment system, like him and I were pushing, and he didn't think that was realistic. He was probably right. And alternatively, he wanted a worldwide regime, Subpart F extended to all CFCs, profits and losses included. And the one thing that he said about that was, we need to have a lower rate, right? Because we can't do this. There's competitive risk concerns, and there are also inversion concerns. As Dan pointed out earlier, there's the issue of this, the regime depends on US tax residency. If US tax residency is not so important, then you have an issue. So here's, I think, the main contribution of my article, and one that I think Ed would agree with, but I'm not sure. So it's a little interpretation that I said it, but I think the Tax Cuts and Jobs Act, as enacted in 2017, is a Kleinbardian law. That's what I call it. And this was an interesting development, because the international provisions of the TCJA were really developed by Dave Camp in 2014. And unlike some other stuff, this was well thought out and had a lot of hearings and so on. It wasn't a rush job. But it didn't seem like there was any chance of it would happen. But then we got the TCJA, and Ed hated the TCJA. And this is the situation where I like the slides, because I can quote to you, as was mentioned before, Ed's wonderful op-ed language. Quote, the Tax Cuts and Jobs Act, this year's Christmas present to the donor class, is an abomination. Its top-heavy distribution of cuts, its wasteful mistargeting of incentives, and its funding for permanent corporate tax cuts via tax hikes on millions of ordinary taxpayers have been widely publicized. From the other direction, whatever virtues this bill might have are completely swamped by its $1 trillion plus impact on government deficits. But before moving on, we should review some of the process through which this bill was fashioned. He really meant this, right? But what's weird is that the international provisions were really based on the Camp draft, which was heavily influenced by Ed's own articles. And the process for those was fine, other than the beats, which is a late addition. But for guilty in particular, there was a very conscious, slow development that was influenced by Ed. And so first of all, one issue was to reduce the tax rate from 35 to 21. And basically that was Ed's suggestion, right? He wanted a lower rate. Then he said, guilty subjects all the income of the CFCs above an exempt amount to current taxation under the guilty with a limited foreign tax credit. And even though he may have thought that the corporate tax rate cut was a little bit too high, I don't think he would have really disapproved. And then he wouldn't have liked the participation exemption, but he would have known that most US multinationals, it's based on 10% return on QBI, the tangible assets abroad. Most of the big US multinationals don't have a lot of tangible assets abroad, so therefore that's pretty meaningless. And I'm sure he liked guilty, even though he may have disproved the detail, like the cross-crediting, for example, that was also already mentioned. We don't have a full-fledged Kleinbardian assessment of international tax provisions because he was ill, but we do have a slide deck from January 2018 in which he summarizes critique of the law. And he had many objections with the law as a whole, as well as specific provisions, like he hated 199 cap A. Everybody hates 199 cap A, then Shavio hates 199 cap A. And I hate 199 cap A, but we have it. But what he doesn't like about international provision is just exactly what I mentioned, the fact that guilty allows for cross-crediting, and the fact that he didn't like the incentive that the exempt amount created for the future shifting of real investment offshores. But he knew, I'm sure he knew, that most of the international provisions were consistent with what he proposed in the stateless income articles. This TCJ did away with the local problem. It imposed a relatively high retroactive rate on the accumulated past offshore earnings of US MNEs and a current tax at a reduced rate on the future earnings. And his main objection was really to the rates, not to the structural features, but he knew that rates can be changed, right? So now we finally get to what I found most interesting, and this slide pretty obviously was done in the past week, right? And it's not in the article, because we now have, and maybe passing today, what timing, the Build Back Better legislation that is pending in Congress, right? So what are they doing? And this is something that Treasury worked on, and the Democrats in Congress worked on, and it went through a lot of work. So what are they doing? Well, so first of all, they raised the guilty rate to 15% from 10.5. They reduced QBI, the exempt amount, to 5%, and they do it country by country, right? I think Ed would have loved all of that. I mean, he would have liked to get rid of QBI altogether, but this, I think he would have said, this is a not unreasonable compromise. And that's what I think anyway, but I think Ed would have said the same. And then he said he wanted to, I mean, we are going to hopefully raise the beat rate to 18%, but most importantly, it's conditional on the tax in the residence country. I think Ed would have liked that too, because it's, again, consistent with his view that it's fine to allow profit shifting to some extent if there is an actual tax at residence, right? And then there's the book-based corporate tax of 15%. I don't know what he would have thought about that. And a global interest limitation, again, I'm not sure what they would have thought about that. But generally, I think he would have really liked this. And I also think that this pushes the law even further in Ed's direction. So I think he would really have approved of this, by and large, within limits. That is, he would have liked guilty at 21%, like the president proposed. He would have liked no QBI, like the president proposed. He did not like, and I can understand why, FIDI, and he would have, preferred that it be abolished and not just tweaked with. But, I think he would, by and large, accepted this, as evidenced by the way he commented on the TCJ. Let me conclude by just saying, again, a few words about, what I think of Ed as a man. And here there's a story, and I do not know whether it's true. So let me, but it's a story that I heard when I was at Wachtellichtung. And the story is this, that when Peter Canellus and Ed Kleinbard were both at Cravath, as was mentioned, and Ed was a first-year associate, and Peter was much further along, more senior. And the head of the tax department was a partner whose name I don't remember, and he made a terrible mistake on a deal involving IBM. and he blamed Peter, that he said this was Peter's mistake, he didn't know. And Peter was fired as a result, was told to leave the firm. He was close to partnership and so on. And Ed left, and that was the reason that Ed left, because he was loyal to his friend and he really didn't like the way that Peter was treated. That's the story that I've heard. Les was saying it was because he didn't like transfer pricing documentation. That's possible too, that as a first year associate, he was bored. But in any case, he went to Cleary, Peter went to Wachtel, and the rest is history. But this was, I think Ed was loyal to a fault to his friends. He was a wonderful person. He was really, really generous. And I was lucky that towards the end of his life, I really got to know him reasonably well, although of course not as well as most of the people speaking today. Thank you very much.
Great. When we go to our panelists, yeah, I think we'll just do this whole thing, and then we'll ask for comments and questions and everything. So Rosanne, you're up.
Okay, I assume that you can see my slides.
Yes.
Great. Okay, well, it's an honor to be speaking here today. And I'm going to talk a little bit more about stateless income. I'll say some of the stuff, I'll repeat some of what Reuven said, but I think it's worth repeating because, as the title of my talk here today says, stateless income really does change everything. So as we all know, about 10 years ago, Ed published Stateless Income and Lessons of Stateless Income. And in it, he wrote, "The pervasive presence of stateless income tax planning changes everything." And what I want to argue today in my remarks, and it's an easy argument to make, is that Ed Kleinbard changed everything. Now, I met Ed at Dan Shaviro's tax policy colloquium that we've heard a lot about already many years ago. He had started coming, and not surprisingly, he was making incredibly insightful comments in his usual hilarious style. My long-term co-author, Harry Grubert of the US Treasury Department, would always ask me about the seminars. And I told him that this guy I knew nothing about, named Ed Kleinbard, had started to come. And Harry said to me, "Wow, that's great for the seminar. He's amazing. He's a New York tax lawyer who's an absolute expert on financial products. And Treasury staff fight each other to get into the meetings when he comes just to learn from him," which I thought was really a great story. So Ed and I became friends. And at one point I made extensive comments on a paper of his, and we decided to meet for lunch to go over them. At that point, he confided to me that he was thinking of leaving practice and going into academia. And this was before JCT. And I told him that he would hate it. I told him it would be too slow for him and he would find academics extremely frustrating and that he would hate writing for law journals. Can you believe how wrong I was? I mean, couldn't have been wronger. I did think academia would be too slow for Ed, but he really elevated the job to another level altogether. It's really rare to find someone who uses his position as a professor to make such important contributions to scholarship while working so hard for students, for policymakers, for the popular press, for the common good of his country, and for the world. Really just an incredible academic. And I really just thought it would just be way too slow for him, but he just didn't accept it the way it was. So how did he change everything? What did he do? Well, what he did was he put the spotlight on stateless income. Just to review, I think we know what stateless income is. It's income derived by a multinational group from business activities in a country other than the domicile, however defined, of the group's ultimate parent company, but which is subject to tax only in a jurisdiction that is neither the source of the factors of production through which the income is derived, nor the domicile of the group's parent company. And this is how he wrote it in Stateless Income. In other words, it's income shifted from a high tax jurisdiction like the US or Germany to a low tax jurisdiction like Ireland, and then to a tax haven that typically imposes no tax on the income, which is flowed there in the form of interest, dividends, and royalties. So Ed called these shifted profits stateless income, and the name really stuck, as we all know. It's not easy. It wasn't easy at the time to understand why stateless income was a problem for the United States. And his genius was his ability to explain the problems to everyone. He coined a phrase that I think changed the world of international taxation. So what do we know about stateless income? What was new about it? Well, we knew a lot about income shifting, which is part of stateless income, but not the whole story. We knew the role of transfer prices, the allocation of debt, and intangibles in income shifting, but the focus had really been on income shifting out of the United States. we knew that the kind of traditional income shifting, I would call it, we knew that income shifting lowers revenue. We knew it had real effects. We knew it magnified the attractiveness of investing in low tax countries, and that it weakened the negative impact of a high tax rate on the desirability of location. And around the time that Ed started writing on stateless income, Harry and I have published research that showed that foreign to foreign income shifting that was made possible by Check the Box was a growing problem. So we had kind of seen this. It was really Ed that just told the world about it. And we had documented the growth of equity income in low tax countries post Check the Box. We wrote that there was almost 100% growth in the income of foreign affiliates of US parent companies in major low tax countries, Bermuda, Cayman Islands, Ireland, Singapore, the Netherlands, Luxembourg, and Switzerland. And we posited that Check the Box was likely responsible for the increase in equity income in havens and the decrease in the foreign effective tax rates that we had calculated the US multinationals were facing post 1996. And Harry had written a paper that showed there was a weakening link between real investment and the location of income. But it was Ed that really put it all together and explained how the US was operating a system that allowed for the creation of stateless income, and that the ability to create stateless income really changed everything. So how did it change everything? It destroyed the concept of source. And some of these slides are, some of what I'm putting is exactly from Ed's slides. So in terms of destroying the coherence to the concept of source, Ed pointed out that solving first order source rules accomplishes nothing if stateless income tax planning can then move the income elsewhere in a second step. It privileges multinationals over domestic firms through the process of capturing tax rents, the stateless income generated in high tax locations that can be converted into low tax income. Stateless income was eroding the domestic tax base through tax arbitrage through borrowing. And this was different from the US base erosion through traditional tax price transfer pricing strategies and cost sharing. So he was really making points that that hadn't been made very well before. And it results in this situation in which you have multinationals that aren't really suffering a significant competitive disadvantage with foreign multinationals. US firms arguably had a competitive advantage in stateless income planning over foreign multinationals and domestic firms that are not multinationals. And this was a very important point. And as Reuven already told us, it contributes to lockout effect. It results in this lock-in in that taxpayers couldn't get their hands on the money. And that led to what Ed called dumb investment decisions. It leads to domestic borrowing for cash needs, exacerbating the domestic base erosion. And he wrote, and Dan had talked about this before, he wrote that tax planners, and he said that tax planners worked in tax distilleries, could handle only so much, and that the distillery was breaking under the weight of foreign permanently reinvested earnings waiting to come home. And the cost of maintaining this tax distillery and the planning apparatus was leading to massive deadweight losses. And what I think was really important, there's so many important things about this paper, but he helped us understand that foreign to foreign income shifting is a problem for the United States. He wrote, domestic base erosion plus tax rents are the principled answer to the question, why should the US care about foreign tax minimization? And what he really showed us was how profit shifting turbocharges the attractiveness of US multinationals investing abroad. What I'm showing you here, this is just an example of how Ed's work on stateless income can really help economists understand effective tax rates. And these are and how stateless income can impact effective tax rates. These are effective tax rate simulations that Harry and I put together. And we looked at situation before and after Check the Box. And what we had was a US multinational making an investment in a low tax location, and there their tax rate was 5%, or a high tax rate location, and there their tax rate was 25%. Versus in the United States where the tax rate was 30%. But what we added in here was the tax haven and the ability to shift. And you can see that the US system was already very favorable to multinationals before for a low tax investment, minus 18%. But after check the box, it goes from a minus 18, so it's a subsidy of 18% versus a subsidy of 23.6%. And you see with the high tax investment, you see this decrease in the effective tax rate of investing in a high tax 25% location, where before check the box, that would be 24% effective tax rate. It goes down to 13%. So that's kind of like a nice marriage between Ed's writing on stateless income and these real effective tax rate calculations. As I'm arguing in this, Ed really changed everything with stateless income. And the paper, I read it again to prepare for this. It's an absolute tour de force. It's the only piece you really need to read about the US tax system before the Tax Cuts and Jobs Act and what research told us about the state of the tax system. He was so good at, of course, we all know turning a phrase, but also of just gobbling up and really understanding the academic literature. He cited everything that needed to be cited. And I'm very thankful for him because he cited my work with Harry a lot, which was very nice of him. So Ed changed everything. He coined this phrase that changed the world of international taxation. It was referenced by finance ministers and treasury secretaries around the world. I found lots of quotes from Jack Lew, former treasury secretary, and finance ministers in Australia and other places along the lines of, we have to do something about stateless income. It was covered by the media worldwide. I Googled stateless income, more than 27,000 hits. He heavily influenced legal, economic, and accounting scholarship. You can find articles in all the top journals in these fields citing Ed's work. And we haven't talked about this before, but it provided the blueprint, I think, for OECD's BEPS action plan. I found this quote from a blog by Pascal Saint-Amans and Raphael Russo from the OECD working on BEPS. And this was back in 2014, and they write, last weekend, the OECD presented its first BEPS recommendation to the G20 for an international approach to put an end to so-called stateless income. I mean, that's really incredible. 7 actions are being proposed as part of a 15-point plan. The other thing he did, what stateless income did, he changed corporate tax statistics. And he did this through the BEPS country-by-country reporting. To deal with stateless income and with entities and stateless entities, the BEPS Action 13 report states that multinationals country-by-country reports have to include tax jurisdiction-wide information related to the global allocation of income, taxes paid, and economic activity. And so you can see here, we never saw this before. We never saw statistics that were reporting on stateless income, stateless entities. And Ed, Ed actually, in a sense, he created a new tax form, because where does this BEPS information, this OECD information come from? This is from an OECD report, by the way. It comes from our new Form 8975. I mean, that's really a big deal to create, to be the impetus for a new tax form. He influenced the policy proposals at home and abroad. You can find stateless income integrity rules in other countries, Obama budget proposals to restrict the use of hybrid arrangements that create stateless income. As Reuven has said, GILTI really is taking aim at stateless income. So he influenced policy around the world and provided the most cited academic explanation of the double Irish Dutch sandwich. Just ask Wikipedia. That's what, if you look it up, you see a site and it says stateless income is the most cited academic explanation of the Google double Irish Dutch sandwich. And he absolutely had an impact on my research. Harry and I thought a principled territorial system was better than the current system. I think there were good arguments for that, but throw territorial from the train. Ed's article in Tax Notes really threw water on that idea. Here he writes, the eradication of stateless income in the field is a highly implausible scenario. And this was in relation to a territorial tax system. I thought that worldwide consolidation was not much better than principled territorial. But after Ed proposed worldwide consolidation, Harry and I decided to write a paper where we would compare worldwide consolidation to territorial to the current system. And he kind of won us over, except for the problem with inversions. As he writes in Lessons of Stateless Income, and Reuven talked about, it would prove more robust to the corrosive effects of stateless income planning, a worldwide consolidation system. I would say that thinking about stateless income and Ed's writings led to the recommendation of a per country minimum tax that we made in our paper in 2013 in the National Tax Journal. We wrote that it would be more advantageous than repeal of check the box, more effective in discouraging income shifting and raising the effective tax rate in low tax countries, and it would generate US tax revenue on income sheltered in havens abroad. And I'm about to finish up in case anybody's worried about time. Going back to those effective tax rate simulations, you can see that with the per country minimum tax, that raises the effective tax rate of an investment in a low tax country from what we said was 5% to 5.6%. So it works pretty well. I just want to say thank you, Ed. That's it.
Great, thanks, Roseanne. That was very helpful. I'm going to ask you for your slides for my article that Joe and I are writing. And next up, we have Thornton. So Thornton, take it away. Thornton, we're not hearing you or seeing you, but we see your slides. At least speaking for myself.
Yes.
I'm sorry about that. I think
Here you are.
I couldn't unmute myself while I was sharing my screen. So I had to stop sharing my screen in order to unmute. And now I will share it again. Sorry about that. Hello, and thank you very much for this opportunity to talk about Ed. I'm sorry, I'm on the wrong slide here. Very good. Let's get back to the okay. So anyway, thank you very much for this opportunity to talk about Ed, from whom I learned so much, both about financial products and about international. So forgive the play on words in the title, but I thought Ed, whose sense of humor was more elusive than punning, might forgive the fact that I point out that he was Ed, could be short for educator as well as Edward. Anyway, I first met Ed in the early 2000s as a new PhD working on financial products and institutions at Treasury's Office of Tax Analysis. And I had no idea that other economists were actually fighting to get into some of the many meetings that I took with him and the Treasury and IRS staff. But it was a privilege. Ed brilliantly understood the economics of financial products, of course, but he was also extremely witty and illustrated a broad concern about policy issues going well beyond the financial products and institution scope of debt versus equity and capital versus ordinary. So fast forward about a decade, I next encountered Ed working for the IMF Fiscal Affairs Department. Ed was then at USC, having done a stint leading the Joint Committee on Tax. And at the IMF, I had the opportunity to collaborate with him on two projects. There was a 2016 IMF working paper, also with Kim Clausing, which was a general critique of the then, the pre-TCJA US corporate tax and suggestions for reform. And in that role, I was kind of a master distiller, AKA editor of Ed and Kim's contributions, which drew on the wealth of their research on the topic. And then in May of 2018, I actually traveled with Ed to Dublin and also with the IMF Article 4 team to evaluate the impact of the TCJA and also the OECD BEPS process on the Irish corporate income tax. So in these projects, I learned that Ed was not only brilliant and witty, but I also got a glimpse into how incredibly hard he worked. After getting through the bureaucracy of signing on to an IMF project, he really set the pace for everybody else in terms of just, digesting a huge amount of material very quickly. And, he had just such an appetite for knowledge. It was truly impressive. So I'll just talk in a little more detail about each of these projects. The working paper with Kim was a critique of the pre-reform corporate income tax, which, as Rosanne and Reuven have discussed, he saw it as a high-rate quasi-territorial system, despite, the worldwide veneer. US M&Es are highly adept at using international tax norms to minimize their corporate tax burdens. They're not disadvantaged vis-a-vis foreign multinationals. The real uneven playing field is between domestic corporations in all countries and multinationals in all countries, because the domestic companies can't play the same cross-border income shifting games. But so the engine behind inversions was not the U.S. worldwide tax so much as the desire to strip income out of the U.S., where foreign multinationals really did have an advantage. And we put forth two reform proposals: a more radical reform, which was based on Ed's dual bite proposal, which you'll hear more about later. That would be a rent tax on worldwide consolidated income with no deferral. And corporations would tax the normal return to individuals through a corporate level withholding tax, but that would be on the residence principle. So they would only withhold that tax for US multinationals would withhold that tax for their US shareholders, including nonprofit such as pension funds. Although we sort of bowed to the political controversy of doing that. And then we also suggested a more moderate reform based on the Obama and Camp reform proposals, which would be kind of a stepping stone to the radical reform, which was a territorial income tax at 25 or to 28% rate. But there would be a strong country by country foreign minimum tax. And of course, what we got not too many months later, well, first we got Donald Trump, and then we got TCJA, which had some of the features of our reform proposals, but a significantly lower rate, 21% rather than 25%. And the GILTI also had a lower rate than we had suggested. Typically, it had foreign income pooling. So kind of built into GILTI is a continued incentive for multinationals to shift income from high tax to low tax countries.
There's a small there, I know it falls.
So then going on to the Irish tax reform mission, found that Ireland was unlikely to be seriously harmed by TCJA. There's a lot of concern about the radical reform, and particularly the 21% tax rate. But the US really truly is huge in Ireland's economy, or it was at the time. It accounted for 2/3 of Ireland's massive FDI stock, which was almost 300% of GDP, and more than half of that was channeled through third countries, many of them, low tax countries. And so using a model that I had in another working paper with some IMF colleagues that year, we thought that this would reduce Irish FDI stock by about 10%. So not negligible, but not a catastrophe. We also thought that, given Gilty's effective rate of 13.125%, Ireland was actually quite well positioned, with their famous 12.5% effective tax rate. And we thought that widespread IP repatriations by US multinationals would be unlikely, given the temporary nature of many of TCJA's provisions. Tax rates tended to go up over time, bonus depreciation would be withdrawn, and the FODI, in particular, foreign derived intangible income regime, looked particularly fragile given, concerns about compliance with world tax or the WTO rules. We got that kind of about 75% right. There have been some significant IP repatriations by companies like Google, but many MNEs have not moved their IP back to the US. Anyway, but we did find that, the reforms coming from OECD BEPS and their enforcement through various EU measures like the anti-tax avoidance directive, those pose a potentially more fundamental challenge. The Irish tax rules providing for the main avoidance vehicles, such as the double Irish Dutch sandwich and kind of the successor regime, the single malt, which is kind of an open-faced sandwich that moves income to directly to Malta, which has a 0% tax rate on foreign earnings, rather than from the Netherlands and thenceforth to Bermuda. Those things were already under pressure. Ireland changed its corporate tax residence rules in 2015. And the single malt, that was based on a tax treaty, but the hybrid rules, as they kicked in, we're going to put pay to that as well. Those features of Irish law were under pressure. And we also thought that any tightening of links between income and production factors or sales, such as formulary apportionment, could pose a fundamental challenge to the Irish tax base, where there was not a lot of actual source-based production going on. And then, of course, it's a pretty small market as well. So just to follow up, bring everything up to date, as you know, Ireland recently signed on to the OECD BEPS 2.0 deal, which it looked originally back in July. They were not signatories, but they did sign on in October. And this was kind of a big deal because the Irish Department of Finance estimated that, pillars 1 and 2 they're going to cost about 2 billion euros, or about 0.5 point of GDP to Ireland by 2025. But they felt this was in their interest. If they didn't participate in Pillar 2, the reciprocal arrangements built into that would increase the revenue loss to Ireland without actually lowering the tax burden to the multinationals. So they did come aboard for that, and they're going to have a bifurcated CIT rate, 15% on the multinationals, with at least 750 million in income, and they've kept the 12.5% for everybody else. And that's kind of reflective of economic reality. I mean, the sense that I got from being in Dublin with Ed was that, it was very much a bifurcated economy. A lot of foreign income had washed through Ireland, but that, the economy relating to that was kind of a thin veneer. It had not been transformative in general. Ed, commented upon in various ways, one of them being that he couldn't get any really good shopping done there. So but Ireland was trying to remedy that already. For example, by implementing one of the first BEPS compliant patent boxes that is really based on, local investment, local performance of local R&D. So trying to deepen the ties between international income and local economic activity. Pillar 1 is actually a more serious challenge for Ireland than Pillar 2 because of course, it reallocates the taxing rights from IP host countries to market countries. And Ireland, again, is a very small market. The US, conversely, is a large market country. The US could gain from Pillar 1, but just because it's in our rational self-interest, of course, doesn't mean that Congress is therefore going to implement it. And finally, what would Ed think of the current US CIT reforms? I think he would be disappointed, as I am, that they're despite the Biden and the House Ways and Means trying to implement a rate increase. We're going to stick with the 21%. In its current incarnation, both because of the tax base itself and also because of the underlying sort of oligopolization of the US corporate sector, the US corporate income tax really now is functioning like a rent tax. So you can sustain a higher rate without having creating a lot of economic distortions. So a higher CIT rate would be really both efficient and progressive and a good way to raise revenue. CIT also functions as an accrued wealth tax on individual shareholders, many of whom realize capital gains. So that's another very good reason, I think Ed would say, to raise the rate. Instead, we have this 15% minimum tax on global book income and a 1% transaction tax on stock buybacks. So running that through the Kleinbardian rubric, I think Ed would say that the minimum tax has some attractive features. There's worldwide consolidation, and then the lower rate makes for a narrower debt equity differential. But conversely, there's a heavier tax on the normal return, so it's more distortive. Also layering on different regimes worsens complexity and reduces transparency. And the percent transaction tax on stock buybacks, that could serve to exacerbate corporate lock-in. I mean, share buybacks as opposed to dividend distributions allow corporations to return money to shareholders in a kind of a cherry-picking manner that allows the more tax insensitive shareholders to realize gains without triggering gains or taxation for the more tax sensitive. So, again, a higher CIT rate would be preferable there. On the other hand, I think Ed would approve heartily of the GILTI reform, going from a pooling regime to a country by country minimum tax. Very positive step. Of course, this also aligns us with international norms, and to the extent that there's greater correspondence between U.S. and foreign corporate tax practices, that reduces opportunities for evasion. And so that's all I have. Thank you so much.
Great. I think we are actually on time, by the way, which means there might even be a little bit at the end for if people want to ask questions and make comments about anything we've had so far today. And so now, Vicki, looking forward to hearing from you.
Thanks. I'll see if I can keep it to 10 minutes so we have a little bit of time. And I will also see if I can share my screen, which will be a challenge, but let's see. For some reason, let's see. I thought I had this right here. Sorry. This worked great. Oh, there we are. It worked. Sorry. was going to say it worked yesterday. So this, anyway, I want to say it's, as others have said, it's an incredible honor to be asked to speak in this conference and this event for Ed. Others have said it, but it's true. And I want to thank the organizers and Suzanne for asking me to do so. We'll hear a lot more about the Ed's business enterprise income tax proposal in the next panel, so I won't even try to preempt that. But I do want to speak about my favorite part, which is actually separable from that, and that is Ed's earlier proposal embodied in it for what he called the cost of capital allowance, or COCA. As Les mentioned, this was, I think, first published around 1989 by Ed. Others have subsequently referred to this in relation to what I would say is its less satisfactory cousin, the allowance for corporate equity, or ACE, better known. Anyway, the COCA has been referred to as the ACC, allowance for corporate capital, to distinguish it from the allowance for corporate equity, or as many of us referred to it over the years, the Kleinbard ACE. So to describe the COCA simply in Ed's words, under the COCA regime, a business enterprise would deduct each year a time value of money charge on all of the capital invested in its business, regardless of whether the enterprise raised that capital by issuing debt or equity. This COCA deduction would replace the current law's deductions for interest expense. And I think the reason that I am so enamored of Ed's of that formulation and the COCA proposal that Ed made was because I began struggling in law school 40 years ago with the tax laws and various judges puzzling, at least to me as a law student, not to say arbitrary and capricious, distinction between debt and equity. And so the COCA sort of fell like rain in the desert, or some other equally strained simile. And I became very attached to it, and hence indirectly to Ed. But so to return to our international focus of this panel, looking at the COCA, how did Ed see the COCA, his COCA, interacting with and contributing to improvement, or an improvement in the international tax architecture? Well, one, he noted that a repeal of the domestic interest expense deduction against foreign income for calculating allowable foreign tax credits would be one outfall of adopting a COCA. There'd be a huge, obviously, reduction or elimination of transfer pricing issues around inter-enterprise debt, or as Ed called it in congressional testimony, the erosion of the US domestic tax base through debt-financed tax arbitrage. Clearly, Ed felt that the interest limitations of 163J were insufficient to prevent earnings stripping, and presumably COCA would mitigate that problem. And then turning to the interaction with the BEAT, of the COCA with the BEAT, the time value of money returns that US citizens earned would be subject to the minimum inclusion mechanism of the BEAT, regardless of where the investment was made, and therefore the location of US persons' investment would be neutral from a tax standpoint. So those are all good things that Ed foresaw at various points as coming out of a COCA in an international context. It wasn't perfect, though. Maybe we should, for a moment, look at what the COCA would not have done or do to mitigate the problems of multinational tax avoidance in the current world architecture. And one instructive example comes from Belgium's ACE, and again, an ACE, not an ACC, as it was in place in 2017, at least. To give a simplified example, Belgium permitted the creation of special purpose vehicles, SPVs, to intermediate between multinationals resident in country one, who wanted to invest in subsidiaries in country 2, one structure would involve interposing an SPV in Belgium funded with equity from country 1, and then having the SPV on lend the funds to country 2. Pretty straightforward, simple example. And given that Belgium had this ACE, there was no net income arising to the SPV in Belgium as long as the notional interest deduction regarding the investment in the SPV was at the same rate as the interest charged, the actual interest charged on the country 2 loan. And the country 2 subsidiary would get the interest deduction. Typically, the country 1 parent could get a dividend from the SPV free of tax, at least under a territorial system. In 2016, the High Council of Finance in Belgium estimated that about 40% of all the notional interest deductions in Belgium were attributable to arrangements like this. So that was viewed as quite problematic. But, and again, bringing us back to the COCA, changing from an ACE to a COCA wouldn't really in and of itself mitigate that type of result. What might? Ed envisioned his BEIT and COCA as in effect a residence-based system, as the foregoing examples I gave. But he acknowledged that his proposed structure could accommodate a destination-based solution as well, the COCA. And in fact, the ACC concept has been theoretically extended in the context of a destination base. Notably, that was done by Alex Clem and Shafiq Habous from the IMF Fiscal Affairs Department in 2018, where they compared the properties of a destination-based cash flow tax with those of a destination-based ACE or destination-based ACC COCA. Time certainly doesn't permit me to give a total recitation of their analysis, but suffice it to say, the DBACC does relatively well. As the authors note, quote, in a destination-based setting, the advantage of an ACC or COCA versus an ACE are even greater than in an origin-based implementation. Just to quickly go through why they find this, most intuitively, of course, the DBACC, like the DBCFT, entirely removes the possibility of profit shifting through the debt structure, and the DBACE does not do that, since it retains interest deductions. DBACC also beats out the DBACE in robustness to other forms of profit shifting, perhaps less intuitively obvious. There are 2 ways to produce a destination-based rent tax, as many of you will be familiar. First, through border adjustability, which is what's usually said in the case of a DBCFT, exports are deductible from profit in the exporting country and imports are taxable. But if the imports are intermediate goods, they're then allowed to be deducted from profits in the importing country. Or alternatively, to a border adjustment, imported inputs could be left untaxed, but then be treated as if they were non-deductible. And that case, while it's robust to profit shifting, is much harder to design and implement in the case of a DBACE or a DBACC, because there's still depreciation instead of expensing, to oversimplify. But on the other hand, the authors of this note found that if you were implementing the destination based through border adjustments, the DBACC, that is the COCA, definitely beats out the DBACE. So that was a point for Ed's approach. Finally, revenues would be less volatile under either of these than they would be under a DBCFT, and there wasn't too much to choose between an ACE and a COCA in that context. So in sum, Ed received my vote for his COCA before we even got to this international extension, but under either an origin or destination system, it's a quite robust system that improves a lot on the current state of affairs. So finally, I'd just like to close on a personal note. Unlike many people here today, I really only got to know Ed later in my professional life, and certainly pretty late in his. But he became one of my favorite colleagues in the tax policy world. I mean, in addition to what we already know, what we all know was his obvious policy brilliance, he really did have a heart of gold. And certainly that was witnessed, among other things, by his concerns about this country and the world's increasing inequality, about which we're going to hear more later today. But suffice it to say that in an early version of his BEIT work, Ed referred to the concept of economic rents or inframarginal returns as, quote, Hello Hampton's returns. But this heart and the somewhat wicked sense of humor that always lurked around Ed, sometimes hid beneath his perhaps not entirely intentionally cultivated curmudgeonly persona, which was one of the things that I found most endearing about him. In regard to that, and since this is an international panel, I just want to finish with a picture that was taken during one of Mike Devereaux's Oxford Center for Business Taxation conferences. This was an annual event at which Ed was a regular, though at which he had always hitherto refused to take part in annual pre-dinner punting. But somehow in this particular year, he had been persuaded to join the punting. And you can see from the expression on his face just how very much he seemed to be enjoying it and how pleased he was to have finally participated. But that was Ed, and we certainly miss him. Thanks.
Well, great. Thanks for those great remarks. We have actually like 5 minutes left if we like. I just want to, hopefully there are people with questions or comments. Just want to briefly say it's kind of astounding. You listen to this panel and this is an entire career, except it's actually something he did. It's like 1/3 or 1/4 of the time in the last 1/5 of his career. So that's kind of amazing.
Yes.
Anyway, if anyone has questions or comments or anything else or remembrances, we do have a couple of minutes. I don't see, I guess there'll be the hand raising function, hopefully, if anyone wants to. And we can just take it's a long day, we can just go a couple minutes early if that is our choice instead. So going once, going twice. I deliberately didn't come up with the moderator often with like my question because I could talk about Ed's International for a long time, but we've already done that. Okay, if there's nothing, Suzanne, what do you think? Should we just say see you all in 34 minutes? There, yeah, I'm sorry.
I think we have a question.
Yeah.
I just, if panelists may pose questions as well. I just actually had a question for Reuven. When I was thinking through the current GILTI reform, I was actually thinking that Ed might, given his preference for a rent tax, that he might think that reducing the QBI to 5% might not be such a great idea in the current low interest rate environment. Maybe 5% return on capital assets does constitute a rent tax, but in what we think of as, sort of more normal times, that might not be adequate. And I was even wondering if, he wouldn't have thought that the US should perhaps follow suit with the BIPS Pillar 2 carve out and allow some sort of return on payroll as well. I sort of have a different perspective on his reaction to QBI, I guess from the Irish tax mission, which was May of 2018. I think by that time, I seemed to get the impression from him that he didn't think that the 10% QBAI exemption was such a big deal anymore. Maybe that wasn't his initial reaction, but I was just, I wanted to draw you out on that point a little bit more, or anybody else on the panel.
And thanks. I mean, I think fundamentally the question in all of this stuff is, do you only care about profit shifting, of profits, or do you also care about profit shifting of people and real activity? And at least what was my impression from reading Ed and also from the slide deck that he developed about the TCJ in 2018, that he really cared also about the movement of people, and he wouldn't be encouraging something that would result in the shifting of real jobs out of the United States, especially if it's a payroll-based thing. I mean, I think my guess is, but we don't know, is that he wouldn't have liked that at all.
I'll
So it's
just-
sort of
I'm sorry, go ahead.
between the domestic treatment where there's no carve out and the foreign where there is a carve out.
Well, you know, I mean, I think fundamentally, I mean, as I said, I don't think he would have cared that much. And as you suggested, because most of the multinationals that he really cared about that have the highest rents don't have a lot of tangible assets offshore. But, you know, as Kim Klausing and other people have pointed out, this is an incentive in the TCJA to move these assets offshore. And I don't think Ed would have liked that. Domestically is a different issue, right?
Just add two quick points. The first is that Ed was passionate about taxing income, not just consumption, and he wrote about that, but he wanted to do it at the end. He had a lot of reasons, I think good reasons for wanting to do it at the individual level, not at the entity level. The other is just another of Ed's great phrases brought up by Thornton's talking about Ireland. One of his great phrases was the extraordinary returns that US companies are showing in their Irish activities is not just the luck of the Irish. Just one of his many, many phrases. Okay, with that, I guess we're good. It's on my clock, it's 2:59:18. We're 42 seconds ahead. Now we'll hand that off to the next panel, I guess, unless Suzanne has final words.
No, I think that's great. I think we are scheduled now to have a lunch break for those of us on the West Coast. Is lunch